All right. Well, good afternoon, ladies and gentlemen. Today it is June 21st, 2022. It is just after noon here in New York. We just had a 3-day weekend. It was a Juneteenth weekend. I hope everybody enjoyed themselves. We're seeing some interesting action today. Let's just go right ahead. I'm going to share my screen on Discord. Good. Okay, so everybody should see me. So today, we're seeing a little bit of a rebound in equities. The VIX is falling slightly, and we're seeing a little bit of a relief rally. Now, there's been a lot of liquidity being injected from China's central bank. We saw signs of this actually over the weekend. You know, the rest of the world did not have a 3-day weekend like we did here in the United States. We saw the Australian dollar come up to this level right here. And some of you have been asking me, what is that level? What is this level? Okay, it's actually a pivot point, one pivot point that goes all the way back to the 80s. All right, and we actually saw that getting hit a couple times today in the morning and also yesterday. So we had this huge breakdown. We saw a little bit of a retesting of that level, and it's backed off from that level. All right. And then we saw a little bit of a rally here. You know, whenever Australian dollar goes up, generally we see that's a positive sign for Chinese stocks, just because, you know, if China's doing well, they usually are buying lots of metals and minerals from Australia, so that drives up demand for the Australian dollar. Okay. We will see. Okay, we had some positive numbers come out in China last week as well. Some of their manufacturing outputs were the numbers were getting better. You know, apparently, you know, they are reopening. So we will see what happens with that. I still think that, you know, they're probably going to face some inflation over there. I don't think here in the United States we're going to be able to export inflation as well, and so we'll see if they, you know, they have a need for tightening at some point, but, you know, as of now they are injecting lots of liquidity into the market. I still have our FXI put position, which is a little bit underwater now. I scaled in very little bit. Okay. I only have a few contracts. If I scale in more, I'll probably go out a little bit further, probably into September or November, and I'll probably use spreads. This is the one time I did not use spreads. Okay, the one time I don't use spreads and it goes against me like this. That's why risk management, always risk management and a process is key. All right. Should have went with the spread, but it is what it is. Again, I kept it very small. That's why I kept it small, because I wasn't using a spread. But that this could go lower. But I'm not going to fight a central bank over it. Okay. You know, what I think is an opinion. All right, and opinions can be wrong. Again, fighting a central bank is one of the dumbest things you can do as a trader. So we will see what happens with that. EEM also coming up a little bit. We're seeing the dollar coming down a bit. I think this is still going to hold as long as we hold this level right here, this 103, 103.40, 103.20 area right here. As long as this holds, I think, you know, I think we'll be fine. If we close under there, I might have to rethink that EEM short. Okay, I still think EEM is going to have a credit crisis closer to 2023. Okay, but if the dollar comes down a little bit, that you know, it could extend when that happens. All right, and you know, I don't want to be holding a bag until, you know, waiting for this to happen. So if it closes under this level right here in the dollar, I will exit my EEM puts. Okay, I'll just eat this. There's a small loss. I think there's like a 10% loss from where we legged in. So, you know, probably the loss will widen if the dollar comes down, EEM keeps going up. But anyway, I will get out, and reassess what's going on if we close under here, and we'll wait. We'll wait for another sign for the dollar to pop up. Already we're seeing signs of cracks in emerging markets. Sri Lanka is already having issues. They're having mass riots. I do believe that will spread to other countries, like, you know, Latin American countries, Greece, you know, Southeast Asia, Thailand, all these countries. I think they're going to have some issues too. All right. And I think that's going to be closer to end of year or next year. And if the dollar comes down, maybe towards the middle or end of 2023. So we'll see. All right. Again, you know, with options, you have to get the timing right. And if our timing is wrong, so be it. We exit, we reassess, we get back in when the data tells us to get back in. All right. So that is my assessment of what's going on with the dollar, with China, and with emerging markets. We're seeing, you know, let's go back to the domestic front here, here in the United States. NASDAQ roaring back. It was actually closer to 3% earlier today. It is coming back. The small caps are also making a nice comeback. You know, and that's very typical of bear markets. We often see the counter trend movement. You know, that it's a much bigger counter trend movement. Generally, you know, bull market in equities, liquidity is high. And so when you see a dip, it's a fast dip, and, you know, it's usually a very shallow dip, and then it resumes. Whereas with low liquidity markets, and, you know, when interest rates are rising, you know, you see these bigger moves. So I think that this one, you know, little rally here, I don't think it's, you know, it's kind of like, it's not really like the bear market rally we had just about a month ago. This is just a little relief. I mean, I'll believe it more if we go up some more. And again, my plan still stays the same. Once we rally a little bit more, I want to build some put walls on IWM and QQQ. All right. I'm waiting for around the 38,900 zone in the ES. Okay. I'm waiting for that zone. All right. Once we get to that zone, I'm going to start building 6 to 9 months out some put vertical debit spreads, 3-to-1 or 4-to-1 reward to risk ratio, and we'll see what happens then. Okay, it's an overall hedge from a longer term portfolio, but I will lean into that trade. Okay, I will lean into that. I think that's a high probability trade. That will be when I deploy most of my cash. I'm still mostly in cash. I'm like 97, 98% in cash in my speculative account. There's no need to rush into things. I'm just legging in to certain positions at the moment. Okay, I'm just legging in. I want to also take a look at the currency and bond markets and how they are giving us certain signals here. That's the dollar. You know, right now this is the 10 and 2-year yield curve. The difference between the 10-year yield and the 2-year. We are seeing it improve and steepening. This is a positive for bank stocks. All right, bank stocks are rallying today, off a little bit off its highs, but generally the steepening of the yield curve is good for those financial firms. All right, their spreads on loans get larger as this increases. and this steepens. Okay, so we're seeing that steepening. All right. This is our inflation expectation. The market's inflation expectation is TIP over TLT. It's the Treasury inflation protected Treasuries ETF versus the long-term Treasury ETF. I said that this signal, this breaking down here, and if it continues down, it's a signal that inflation is peaking. That doesn't mean inflation is stopping. It just means inflation is not rising as fast as it used to. And we, this, if it were to keep going down like this, that would be a really good signal that inflation is peaking, that it's not accelerating at quite the same rate. It would also mean that in the short term, short term meaning like in the next 3 to 6 months, that the 10-year Treasury is not only the 10-year Treasury, but also the Fed funds rate is going to the expectation is that the market from the market is that it may be the high, the 3.5 to 4 may be the high in the Fed funds rate as well as the 10-year. We will see. Okay, we'll see if that's right or not. We're already seeing yields coming back up, and also this signal is it gapped up today, so we'll see. All right, that's at first last week I really thought that maybe this is it, maybe inflation has peaked, but now we're seeing this. We'll see. I think this is all noise. We'll see if it breaks up or down. Okay, it really has to break down below this in order for it to confirm that this is peak inflation, or this needs to go up. Even if it is peak inflation and this goes down, I do think that later on, maybe mid next year or so, we might see inflation come back up again, especially if the Fed takes their foot off the gas pedal when it comes to tightening. They might tighten until end of the year, and then maybe they say, oh well, inflation is peaking, and then now maybe we should loosen a monetary policy. We should loosen because we're back at normal levels. Generally inflation is a sticky problem, so it generally does stick around for a few years. If the Fed somehow, for some reason, decides to loosen too early, I do think that this will come back. Even if it goes down, I think it will come back later on, maybe in the next season, maybe 3 to 6 months later. We will see. Last week, we had a pretty brutal sell-off in the markets. Not just here in the United States, but also in Europe. Energy markets are in focus. Let's just take a look. I know a lot of you are playing energy right now. Let's first of all take a look at gasoline. I know a lot of you have been talking about how expensive it is to fill up your gas tanks. We're seeing a little bit of a relief bounce in gasoline. We called the top in oil, or at least in oil stocks, last week. I believe it was Wednesday. We were talking about this might be the top in oil stocks. Members were asking about XOM. Man, we should have taken that. We should have taken that put right when we were talking about it right here. We were talking about this right here. We should have taken it. We said, oh, we'll wait. But the market didn't cooperate with us, and it sold off. Could we bounce back? This morning, on Breakfast with Toast, Toasty did mention that he expects that oil to go up. I mean, I think that's a very reasonable expectation. I don't think it's going to break down all in one sudden move. Commodities and oil just generally doesn't do that. Oil does tend to retrace. All right. Toasty said if he were long, he would target that 115. I'm just not playing long. He even mentioned in Breakfast with Toast, if you are going to be long, to be very cautious and to keep it small. I agree. If you're going to be long on this, keep it small. I mean, I wouldn't be long on it myself. Personally, I wouldn't. I think the risk to reward is just not there. There's just not enough juice on this trade. Okay, just not enough juice for me. I would rather wait until we get past 119 into the 120s and then short there. Okay, that's what I'm waiting for. I'm waiting for this to retrace, get back to here, and then let's dump it there. Okay, hopefully the oil stocks will play along. All right, and hopefully it will recover. And if XLE gets here, boom, another short opportunity. For those of you who are not in futures, that would be a great opportunity for you guys. To get to get in on the action. Wait for XLE to come back and back test and retest these levels, and then once we see that it can't get beyond a certain point, probably around here at 88 to 90, if it can't close above there, boom, you can buy some put spreads 3 to 6 months out. I think those will pay out pretty well. XOM. It's one specific stock that one of our members was asking about. I think so. I think this too, very similar structure to XLE. Boom, we get up here. It starts failing. Boom, put debit spreads. Okay. I will personally play the oil futures itself. I am not going to do undefined risk, meaning I am not going to short outright futures. I will be buying put vertical debit spreads, okay? Because what if we're wrong, right? What if we're dead wrong, and what if we short here and it just spikes up, okay? I don't want to be on the hook for that much, and just another reason why I'm waiting for these levels to short, because if I am wrong, I can get out quickly with a small loss, all right? If I enter a short around 121, 122, and it closes above 123, 124, well, that's a good indication that I'm wrong on this trade and I can get out, okay? I can get out at a minimal loss. That's risk management, okay? That's why we don't enter trades just at any level, all right? Or if we're unsure about what the levels are, we scale in little by little. But here, I think it's quite clear. It's quite clear what those levels are. Once we get here, I think the risk to reward is very compelling to put some put vertical debits, and we watch it go down. Now, even if it does go down, I don't really see it going that much below these levels. This, I guess, 105, let's say 105. All right, I don't see it going down past that. I think we may bounce around here for a while until maybe fall or winter. Okay, so let's say we get here as, I don't know, July, August. I think it goes back down to 105, bounces around here for a bit, and then we'll see what happens in the oil markets then. Okay, we will see. I'm not trying to predict the future. I'm just trying to anticipate ahead, a few steps ahead. All right. One of the things that I also wanted to talk to today was, we are expecting this bear market to continue. That has been kind of everybody's expectation. We may see relief rallies, but then we're going, lower. Or at least that's the opinion so far. But what if we're wrong? All right. I'm not saying that, I'm seeing signs that we're wrong. I'm just trying to anticipate what could be. All right. You always want to think about, what if your thesis is wrong? All right. What if we're wrong? What if this doesn't continue downward? What if this is the bottom? I doubt it. But that's just my opinion. What if my opinion is wrong? All right. I think the first signs are going to come with tech, just because everybody, people got out of tech, and tech just got, slaughtered in this sell-off. I think if we see a bottoming, we probably will notice it in the NASDAQ first. All right, with liquidity sensitive and interest rate sensitive equities first. I think that's where we're going to notice. I think if we rally and we just cannot, it just will not go below these levels after it rallies, and we notice that volatility is decreasing, and one of the ways we can measure volatility on NASDAQ is the VXN. The VXN is like the VIX, but for the NASDAQ. All right. Let's say this is trending downward, and at the same time, After this rises, it just cannot get below this. I think that would be a good signal that perhaps for this year we have bottomed for the rest of the year, or at least for the next 3 to 6 months, we've bottomed. It could be. I will confirm when I see that. There's no sign of that. Okay. I'm not trying to predict the future, just anticipating what could be if we're wrong. Okay. Again, I still believe the longer trend is down. I do believe we're still in a downtrend. I believe these rallies are just short-term relief rallies, short coverings, bear market rallies, whatever you want to call it, hedger strike, seller strike, and I think as we get to higher levels, there's going to be more demand to hedge and it will keep going down. But if I'm wrong, I think it will show us, and I just don't see a V move as a possibility. Back when liquidity was high and when we were still in QE era, recoveries were fast, right? Because there was no alternative. What alternative was there? Cash was trash. That was like the saying back then. Cash is trash. Everybody, brokers, investment companies were saying how bad it is to hold cash. And they were then and there was all these V moves, right? All these V moves. I just don't think there's going to be those kind of V moves because there's so many alternatives. Now treasuries are actually paying a decent yield. All right, institutions are now looking at those yields. Or holding cash. Dollar has been going up. It's been in an uptrend. Right now, a 10-year you can get 3 to 3.5. Even shorter term, you can get some decent yields on shorter term bonds as well too. So there is an alternative. All right. So even if it is bottoming, I don't think it's going to be a V recovery. I think it'll probably jag around here. But if we see that if we see that it pops out of this range and then it just can't go down, and at the same time we're noticing VXN coming down, implied volatilities coming down, markets are really stabilizing, the premiums on some of these options are decreasing, then I can definitely see that is a bottoming signal. And again, we haven't seen that yet. I'm just anticipating what could be if we're wrong. All right, and that's how we're gonna know we're wrong, is that if it pops out of this range, it tries to go back down, it can't, and VXN is trending down, or VIX if you're using the S&P 500, implied volatilities are dropping, and then that's when I'll say, okay, maybe this is a seasonal bottom. Okay, and even if it is a seasonal bottom, and let's say we go up, I still think that probably next year, the year after, we may see renewed selling in equities, especially with what I believe is an impending emerging market debt crisis with the dollar being this high. Also, too, I do think that sometime in 2024, the United States government may have to raise taxes due to budget deficits, but we'll see. I mean, those are just those are too far ahead. We'll take things one session at a time. Okay, one session at a time. All right. But that is my take on what's going on with equities. All right. I also opened up another trade. I opened up a gold long as well. And here's the reason why. So this is gold over S&P 500. Okay, gold divided by S&P 500. It goes back to 1976. All right. This is in log scale, by the way, so take note of that. This is log scale. All right. I think we may be going up. This ratio may be going up. I noticed that as tightening happens, not as tightening, but right afterwards we see a little bit of a pop here. We saw a pop here, and the tightening started in the markets. We saw tightening start in the 07-08 crash, actually in the earlier part of '07. It wasn't until '08 that people realized that the Fed was tightening. Back then, the Fed did not broadcast as well what they were doing. All right, and I don't know if you guys watch CNBC. I don't, but there's that famous clip of Kramer at 2008 when he says, "Oh, they know nothing," because at that time the Fed was tightening into when debt was ballooning, and so that it kind of there's an argument that it made the 2008 crisis worse because of all that tightening that they did. They over tightened too quickly. All right, and we saw the gold to SPX ratio go up. I think this is next season for that. Okay, I think we might see this go up. All right. Same thing happened in the 70s when it tightened, and I've been saying this over and over and over again that this market, okay, since November, December of 2021, which is just 7-8 months ago, it really does look like the 70s type market with high inflation. We just got off of a pandemic. Increased military conflicts all over the world, peak credit, right? It happens about every 50 years. In the 70s, it was the Hong Kong flu. We just got off the Hong Kong flu. There was the Yom Kippur Wars, and then OPEC shut off, or Saudi Arabia and all the Arab OPEC countries, they shut off their oil to the United States, and we saw commodity spike. Very, very similar parallels, and so that time too, we saw gold spike right here. Compared to S&P 500. I think we're going to see something like that. So if you go to the commodities page on our Discord, I have already entered a, not very large, okay, scaling in. I am scaling in, okay. Commodities moves tend to not be that drastic. Generally, it's like a very trending. It's not like, small stocks or anything where you have these huge moves. I mean, it is possible, but generally trends and things take a little bit longer in commodities markets, especially in metals and gold. I am in the December's 180, 200 call spread. I legged into it, okay? Somebody, wow. Oof. That was the same number. It was 4 and 4 before I started the recording. So somebody just bought about there seems to be increased interest in this. 1,000, huh? 1,000 is not much, but it's about $580,000 in premium, which is not that much for an institution, but that's interesting. That's been kind of funny actually recently. Every time I take a position, options position, when I took an options position in FXI, EEM, and also now in gold, I noticed that a huge spike of volume happened in the strikes that I was in. I don't know what that's about. Maybe it's just all in my head. We'll see. But yeah, I've already started this GLD. I'm using GLD. I'm just using GLD just because the skew was a little bit more favorable. I got a little bit more difference than if I had used gold futures. If I used gold futures and I bought call spreads on those, in order to get the skew difference of what I had here, I would have had to go a little bit further out the money. So I didn't want to do that. Instead, I chose to use GLD, which is fine. And that way you guys can follow along too. I know a lot of you don't have futures enabled on your account, but I think this is a fine position. This is a fine ETF to use. So that's what I see in gold. And so that's a little bit of an update. Let's actually look at some of the other commodities and see. I still think that, later on when we get the corn report, oh, well, look at that. Huh. I wonder if the report already came out. I'll take a look and see. But if corn planters did not plant enough corn, that could definitely spike, causing more inflation fears, causing that TIP-TLT to go up. Inflation expectation goes up, more rate hiking, more aggressive Fed gets priced in, boom, we could see a little bit of volatility due to that yield spike because of an increased expectation for inflation. Maybe that's why. Maybe that's why the TIP-TLT is gapped up today. I don't know. It's hard to say. Right now, there's a lot of noise from all directions, not just in equities, but also in the bond market, currency market. I think a lot of professional traders got caught off guard after that ECB meeting about a week and a half ago. And since then, I think, most professional desks are, trading desks are recalibrating and reassessing what's going on. We'll see. I think a week and a half ago after the ECB meeting, it was just a bombshell event. And a lot of people got caught off guard. A lot of pros got caught off guard. So we'll see. We'll see what happens. That's corn. Let's take a look at wheat. Wheat. Oh, well, look at that. And soy. Soy still strong. I saw a report that a lot of cows, there was a few thousand cattle in the Midwest that were dying. Initially, they said because of the increased heat, that a lot of these cows were, a lot of these feeder cattle were dying. It could be a disease, or maybe it's the heat. I didn't really read too much into the report. I just saw the figures on how many cows, how much cattle had died. It was like a few thousand. So we're seeing feeder cattle futures go up. Let's see what's happening with hogs. Hogs are going up too. As beef gets more expensive, people will find substitutes. So that is reasonable to see. We'll see what happens with that. Okay. Let me see. And just for good measure, I just want to take a look at the dollar again. Okay. It's recovering some of its losses. We'll see. We'll see. If it really closes here, though, if it closes around here, that is a good signal that we're wrong on our EM. Well, at least not wrong, but at least the timing is off. Maybe it's going to take a lot longer for that EEM debt crisis contagion to spread. Okay, it's already happening. You look at Sri Lanka, it's already happening. I think other countries, they'll come due. Okay. The devil's a knocking, and I think it's not over. Even if it goes down, I think it's going to come back up at some point. Inflation generally is not a quick problem that can be solved easily. Okay, it takes time, and I think as the dollar comes down, maybe the Fed signals that they may stop tightening. Inflation picks up, boom, more aggressive action is expected from the Fed, and then the dollar will go up. That's my outlook so far. Okay. So again, I'm not saying that this is a bottom in equities, but I'm just saying, just in case if we're wrong, we're gonna know. I think we're gonna know, and I think NASDAQ will be telling. All right. This is the most interest rate and interest rate sensitive part of the market. So we will see. We'll see. I still think the long-term trend is down. I think this is a very good area to scale in to SPY shares around 3,400. 3420 or so. I know another member here who does a lot of his own financial modeling. I think he does it for his work. He was able to confirm that that's also a level where his modeling also says is a good value level. So So our models match. I mean, we're probably using the same models. I mean, these things aren't new. You can actually Google evaluation models, and you could, download Excel spreadsheets and play around with those numbers. Your inputs is what really matters. What your assumptions are of what the future may look like. What future interest rates will look like and things like that. That is going to affect what your valuation spits out, or what your model spits out. But for now, we are agreeing that this is a good zone. For now, it may change up or down. Let's say interest rates fall. Yeah, it's going to go up a little bit more. If interest rates rise, then it may be a little bit less, here. So we will see. But right now, this seems like a good value zone. We'll see if we get there or not. Again, I'm not saying we are for sure going to go there. I'm just anticipating, just in case if it does. Okay, we call ourselves Checkmate trading for a reason. We are trying to think 5 or 6 moves ahead. Okay, 5 or 6 moves ahead. I know a lot of you follow cryptocurrencies. Let's take a look at that too. Bitcoin. It's an impressive rally that we're seeing. Actually, why don't we go to Deribit and see what's going on in the options market. I don't need position. Boom. Okay. That's only 15 hours left. Daily, no. We want to look at the quarterly is only 2 days left. I mean, I don't think I've noticed that about 3 to 4 days before expiration, volume starts drying up. It starts moving over to further dated contracts. But let's take a look anyway. 2000 seems to be a volume zone. Still a lot of open interest in 2000. We saw Bitcoin over the weekend go down to 17,000 or so, 16, 17,000 on some news. I think Bitcoin and cryptocurrencies in general, they're having their 2007, 2008 moment. What do I mean by that? In 2007, 2008, we had a lot of banks fail. A lot of them failed because they had risk that was very much intertwined with one another, and it was a domino effect. So, companies would issue these mortgages on real estate, and then those mortgages would be packaged together into these mortgage-backed securities, and then there were companies that were dealing in mortgage-backed securities, and then we started dealing with other derivatives that insured those mortgage-backed securities, and more derivatives on derivatives, and it was just like, all these companies were involved. In the end, it was all tied to the real estate market, and all these risks were just intertwined with one another, and when one financial institution failed or got into a liquidity crunch, it would affect all these other companies in a row. I think that's what we're seeing in crypto right now. We saw already a lot of protocols, lending protocols, different hedge funds that are in the crypto space. They're either failing or they're running into liquidity problems. And over the weekend, we saw a few protocols limit their withdrawals, and they do this in many ways. One of the protocols, Bancor, they promise impermanent loss protection. Okay, so basically, when you're farming for yield using liquidity pairs, you have to put up two cryptocurrencies, like a pair, okay? And if one of those out of the pair starts deviating too much from the other, you have something called impermanent loss, all right? Let's say you have cryptocurrency A, cryptocurrency B, you put both of them up, you post both of them up to for liquidity, and you're trying to farm that yield. If A starts moving up really quickly, what they're going to do is the protocol is going to start selling whatever is rising and start buying whatever's not rising as fast. Okay, and that way, if that's part of the risk that you're taking when you do this. So basically, when this protocol says, "Well, we're no longer going to protect you from that impermanent loss," it stops a lot of people from taking those funds out, because when they do, they might be faced with a large loss. All right, that's one way. Some are just flat out. Some some funds and some protocols are just flat out limiting withdrawals. There was one protocol, Solend, that had a vote on whether or not they should take over a whale's account to basically stop a huge outflow. That definitely shakes the confidence of investors. Okay, especially institutional investors. No institution wants to be at the mercy of a vote like that. Definitely not a good sign. But we'll see. We'll see what happens. And I think there's going to be a washout soon. I think this is just the tip of the iceberg. It's that cockroach theory, right? You see one cockroach, and there's probably more. I'm not a crypto expert by any means. I'm not an expert in any of this, but just from my own studies, just from me studying general financial markets and different crises, throughout economic history, that just seems to be what's happening. So this is usually how it starts. These are the cracks that form, and generally the big problems don't really surface until these little ones accumulate. All right, so we will see. All right, we'll see what happens. But right now there seems to be demand, or there seems to be volume in the 2000 as well. 2000. Then this is for 2 days. Let's actually move out a little bit and see if let's see next week's. Actually, that size is confusing. Yeah, let's just do open and volume. We're starting to see some accumulation. So 15,000 seems to be a demand for hedging there. We'll see. Oh, we're already seeing, whoa, look at that, 12,000. Okay, there we go. So there seems to be some demand and those strikes as far as puts are concerned. Calls, I'm not so worried about calls. I think if cryptos rally, it'll get sold into. I think these are all longs. All the calls are longs. People still are gambling that cryptos will come back. I don't think it's going to be a straight line up. It's going to be a painful recovery. I don't think the big problems have really surfaced yet. Okay. Again, just anticipating. Just from what I know of, just from looking back in history at other markets. Crypto is a different market, though. So, again, we'll take it one session at a time. I just want to take a look and see what the monthlies are telling us. Same thing. Wow. So you see this? 18. So there's a lot of demand for even 20 down, 20, 18, 15, and even 10. So that 15-10 zone seems to be what people are potentially hedging for if my dynamic hedging thesis is correct on Bitcoin. Again, just because it happens for a few months doesn't mean it's the reality of that market. Maybe it's just the conditions that we're in. We don't know. I would want to observe this a little bit longer before I outright say that, yes, this is the case. There is dynamic hedging, institutional participation in Bitcoin. I mean, obviously there is institutional, participation in Bitcoin, but as far as dynamic hedging is concerned, like SPY, like an index ETF, I would rather see a little bit more data before I confirm that. Okay, but it looks like it. And if that theory is, that thesis holds true, then it looks like there's some hedging demand for 1510 in Bitcoin. Quarterlies. Institutions tend to hedge a little bit longer out. It's usually retail that does shorter dated. Institutions usually go 6 months, a year out. Wow. So there is, look at that. I mean, that's 3 months out. Let's take a look at December, end of year. Okay, 15,000, 20,000, 15,000. Lots of demand for hedging at those levels. Why not? Not yet. I think, okay, so people are definitely, it looks like hedging for end of year. Okay, people are getting ready for the end of year. Something, protecting from end of year. I mean, usually a lot of funds, they report to their clients or they report to their management on a quarterly basis, and end of year, that's usually when people get bonuses. Well, at least in Wall Street, they get their bonuses based on end of year performance in the beginning of the year. But we'll see. I'm sure a lot of these crypto funds have very similar structure. Maybe that's what they're protecting, just in case, protecting their performance using some hedging. We'll see. We'll see what happens. But that's what I see in cryptos. I think that there's some systemic issues with certain protocols and certain funds. This may be the hedge fund event. I always say this, that every year there's a hedge fund liquidation event. Maybe this year it's cryptocurrency based. We're already seeing funds being liquidated, getting margin called, restricting liquidity, having liquidity issues, trying to secure credit. These are all issues. We will see as interest rates rise and liquidity goes away in some of these markets. It becomes harder and harder to obtain that credit at a good price. So that's why we're seeing a lot of protocols failing. Somebody mentioned here too that there's some protocols that are stable. We'll see if that lasts. I mean, I'm sure there are a few that are well run. Just like in 2007, 2008, not all banks failed. Some banks were doing well. Some banks that were managed conservatively were doing reasonably all right. And so I figure this will be around the same. We've only seen a couple of cockroaches. I think there's a lot more. I think this is just the beginning. Usually it's like one or two, and then it just like all these problems just surface. There's a crack, and then just whoosh. I still think that moment is ahead of us. We'll see. I'm still recording right now. Do you guys have any questions? Somebody just typed possibly just a very slow recovery. As far as the price in equities, in U.S. equities, yes, I don't think it's going to be a V because, again, this idea of there's no alternative, it's not there anymore. I mean, yields are decent. I mean, you can get 2-year at what, 3.1, 3.2, 3 between 3 and 3.25. That's not a bad yield. There's an alternative. Dollar has been going up too. Cash is an alternative. So I just don't see this being a quick V recovery. Back when interest rates were at all-time lows, there was when stocks was it. There was no other alternative. People would just pour money into every shallow dip, but that's not the case right now. So even if there is a recovery, I do think that it's going to take some, it's going to take some time, and there will be price discovery, as far as price action is concerned. There's going to be some up and down. There's going to be buyers that come in at certain levels, and then there's going to be sellers that are going to take profits. And, I think there's going to be more of that type of price discovery, even if we do recover. That's if, okay? If. I'm not trying to predict the future. Again, I keep repeating myself over and over on that one. Just trying to think of things in terms of absolutes in trading is probably the quickest way of losing money. All right. The market and the future is a spectrum of possibilities. Okay, we just have to be prepared for every one of them. All right, it's like playing chess. You have no idea. There's no guarantee of what your opponent is going to do. You can anticipate what your opponent is going to do based on the positioning on the board, right? And you try to think 5 or 6 moves ahead. Very similar to that. Okay, we're trying to be very strategic here. All right. There are a lot of signals coming out, and I don't think there's a clear signal yet. But I think there will be, and I think it will show in the dollar and in yields. Okay, those are the big daddy markets. Okay, currencies and bonds. All right, equities is like the little brother that follows along. All right, and cryptos is like a newborn infant. All right, so that's kind of the analogy. You know, we just had Father's Day, so I think that's an appropriate analogy. Any other questions, comments, rude remarks? We're still recording. We're live right now. So if you guys are comfortable being live, you can ask away right now, or you can type if you're not comfortable being live. I see somebody's typing. So let's see what the questions are. Nope. Nobody wants to ask anything while we're live. Just give it a minute here. I see someone's typing. Okay, I don't see any questions, so I'm going to stop the live stream so that you all can take yourselves off of mute and ask me questions. I will try to be back on. I'm going to try to do these live streams more often. Okay, I think this is fun. All right. Maybe, you know, right now we're doing this on YouTube. Maybe we get on other platforms as well, like Twitch. I know some of you on private DMs have been asking me, hey, when are you going to be on Twitch? Yeah, we'll try that out, okay? Right now I'm just testing things out on YouTube. Maybe later this week I start streaming on Twitch as well. I might even stream on both. I just have to find a multi-streamer that I can use. So I'm still looking into that, but yeah, you know, today has been great. Hopefully we do more of these. Stay safe out there. Again, if you're going to leg into things, keep it small for now, because I think a lot of signals aren't clear. But we will see, and once we see those moves, I'll definitely let you guys know with another video, or I always post things on our Discord.